Welcome back to class, everyone. For today's lecture module, we're going to tackle a really foundational document for anyone who's an entrepreneur or a freelancer in Canada. We're talking about the T4002 Guide. Think of this as the official roadmap from the Canada Revenue Agency for all things business, professional, and commission income. Honestly, understanding this guide is a skill you're going to use again and again in your careers, so let's get right into it.
So, here's our roadmap for today. First, we'll kick things off by figuring out who these rules actually apply to. Then, we'll jump into the crucial updates for the 2024 tax year. You always have to stay current. After that, we'll get into the real mechanics, the two main accounting methods, how you actually calculate your net income, and the basics of what's called Capital Cost Allowance. And we'll wrap it all up with what I personally believe is the single most important rule in all of taxation.
All right, Section 1. Look, before we can even begin to talk about deductions or income or any of the fun stuff, we have to establish who this guide is even for. Figuring out your status or your future client's status as either an employee or self-employed, well, that's the absolute first, most critical step in this whole process.
So who are we talking about here? Well, the T4002 is specifically built for unincorporated, self-employed folks. This umbrella covers a lot of people. We're talking about sole proprietors. That could be a general business person, a professional like a consultant, or even a commissioned salesperson. And it also applies to you if you're a member of a business or professional partnership.
This brings us to the big one, the fundamental question that has huge legal and tax implications. Are you or is your client an employee or are they self-employed? I can't stress this enough. Getting this distinction wrong can lead to some major headaches and penalties from the CRA down the road.
So what's the deciding factor? It all boils down to one word: control. According to the CRA, you are self-employed if you control the essential parts of your work: the where, the when, and the how. I want you to remember this. It doesn't matter what your contract calls you. What matters is the actual reality of the working relationship. That's what the CRA looks at.
Okay, moving right along to our next section, let's talk about what's new. As future tax professionals, you've got to burn this into your brain. The tax code is not static. It's a living, breathing thing that changes every single year. It's your job to stay on top of it. So let's look at some of the key updates for the 2024 tax year.
First up, a big one for anyone who uses a vehicle for their business. The capital cost ceiling for what's known as Class 10.1 passenger vehicles, it's gone up. So, for any vehicle bought on or after January 1st, 2024, the new cap for claiming capital cost allowance is $37,000, and that's before tax.
And hey, if you or your client are leasing instead of buying, they've thought of you too. That limit has also been bumped up. For any new leases you get into after 2023, the maximum deductible leasing cost is now $1,050 a month, again, before tax.
Now, there are a couple of other really notable changes you need to have on your radar. There are brand new rules that can deny expense deductions for short-term rentals that aren't compliant. Also, digital platform operators, think Uber, Airbnb, they now have new reporting requirements. And finally, you'll want to keep an eye on proposed changes to the lifetime capital gains exemption.
Now we get into the real accounting nuts and bolts. The method you use to report your finances, it dictates everything about the timing of your income and expenses. This is a critical choice, and, for many businesses, it's not even a choice. It's a requirement.
Okay, let's break these two methods down. With the cash method, the logic is really simple. You report income when you actually get the cash in your hand, and you deduct expenses when you actually pay for them. Money in, money out. The accrual method, though, is different. You report income when you earn it, even if the client hasn't paid you yet, and you deduct expenses when you incur them, even if you haven't paid the bill. Now pay close attention. Only farmers, fishers, and self-employed commission agents can choose the cash method. Pretty much every other business has to use the accrual method.
So, that brings us perfectly into Section 4. Once you've figured out your reporting method, you can start the main event, calculating your net income. This is where we take all those accounting principles and actually put them into practice. And remember, your gross income isn't just your sales. The CRA has this little category called Other Income, and it catches a lot of people by surprise. We're talking about things like recovering a bad debt you wrote off last year, maybe you won a prize or a trip through your business, or you got a government grant. Even certain GST/HST rebates that partners receive can fall into this bucket.
You know what's great? The T4002 Guide itself provides a practical template for a sales journal, just like the one you see here. It's a simple tool, but it is so effective. See how it separates cash and credit sales? And even more importantly, look at how it breaks out the sales taxes, like GST and PST. This isn't just about good bookkeeping. This is absolutely essential for filing your sales tax returns correctly.
All right, let's tackle a big one in Section 5. This is a topic that often seems really complex, but it's essential for any business that owns long-term assets. Things like buildings, vehicles, or equipment. We're talking about Capital Cost Allowance, or CCA.
So, what on earth is CCA? Well, the simplest way to think about it is that it's the CRA's version of depreciation. See, you can't just deduct the full cost of a new truck in the year you buy it. Because that truck has a useful life longer than 1 year, the CRA lets you deduct a piece of its cost each year, over several years. And that annual deduction, that's the CCA.
The good news is the calculation itself follows a clear 4-step recipe. First, you figure out the asset's total capital cost. Step 2, you group that asset into its correct CCA class, and there are dozens of them, each with its own rate. Step 3 is to find the undepreciated capital cost, or UCC. Just think of the UCC as the remaining value of everything in that class that you can still claim deductions on. And finally, you apply that class's rate to the UCC, and boom, that's your deduction for the year.
We've now arrived at our final section, and I've saved what I think is the most critical part for last. You can master every single rule about income and deductions, but none of it, and I mean none of it, matters without this. This is the golden rule of tax. You need meticulous records. The subtitle says it all. If you can't prove it, you can't deduct it. Period.
So what does proof look like to an auditor? It looks like a valid receipt. And according to the CRA, a proper receipt has to show all of this information: the date, the seller's full name and address, your name and address, a detailed description of what you bought, and, if it applies, the seller's GST/HST number. This right here is your checklist for audit-proofing every single one of your expenses.
I want to leave you with this final, powerful statement. This is taken directly from the guide itself. We may disallow expenses you deducted if you cannot support them. It does not get any clearer than that. Let that sink in. The point I want you all to walk away with today is this. In the eyes of the CRA, an undocumented expense is simply a personal expense. Treat your documentation with the seriousness it deserves, because it is the entire foundation of a defensible tax filing.